Hi, Harry Dent here for my bi-weekly now rant. Obviously a lot of action in the markets. I've been tracking this channel up in the NASDAQ 100, which is the leading index in this bubble. And by the way, I'll get to it, the only major index, NASDAQ, making new highs around the world after the big February to March crash, which is very indicative of a top right there. And boy, I mean, we pulled well ahead of that channel in what is classically an overthrow rally, and that's what you want to see at a top. We saw a more minor one in mid to late July, which looked like a top as well, but of course this market is persistent, and Jay Powell, Fed chairman, just comes the other day and says, oh, you know, we're not going to worry much about inflation now. So they we're going to print unlimited money, and we're not going to let inflation be a problem. We'll look at it, but they just keep saying we will do anything to stop a downturn, and I've been saying, and it's been proven with 3.4 trillion printed between October and May, exponentially more than the entire quantitative easing over 80 months. In 8 months, they printed that much money. It's crazy. You can't keep doing this, but they keep doing it, and the markets do respond. Lesser. I mean, hey, the market's making new highs. This is insanity with the uncertainty in this economy with this virus hitting and how many industries will come back and win. And I'm telling you, they are not all coming back. And there's so many zombie companies, 19% by the best definition I've seen. They're going to go under sooner or later, no matter what you do with stimulus. So this is crazy, but compared to the stimulus that went into this, and including another 3 trillion with another trillion plus coming soon in fiscal stimulus, this movement in the market is nothing. And the same thing with gold. The movement in gold from late 2008 into 2011, well, there was massive quantitative easing, and that was a big move. But this move is not as big, and compared to the stimulus is much less so. But gold went to new highs recently, and I did not expect that. That violates the whole 30-year commodity cycle, but hey, so does printing endless amount of money. So that's where we're at. And I've gotten questions lately about gold. Well, Harry, you're treating gold like stocks. Well, yes, I am, mostly. They don't always go up at the same time, but gold's been in just as big a bubble as stocks. There was an article the other day on Bloomberg where a major analyst was saying gold is in a bigger bubble than stocks. I do not agree with that, because I have one of the few real fundamental measures for stocks, the spending wave, where they should be. And I've told people and told all of you at the peak in February, it was more than 120% overvalued. That, I mean, stocks can get, versus that fundamental indicator, you get 20, 30, maybe 40 at the extreme. 120%, no, that's the most overvalued stocks have been ever, because they're reaching major new highs, or, back then and now again, in the weakest recovery in history, where corporate earnings have been flat after the first bounce out of 2009. It's only earnings per share going up because of financial engineering companies buying their own stock. This is beyond ridiculous, and we know that, but the bubble never ends. So this stock bubble is at a point, just got over 12,000 the other day, where this is either going into an even more extreme blow off top, which I think is less likely, or this is the big throw over, and this could be a peak. So I showed the other day in the update to subscribers that we either come down and test the bottom of this channel going up, and that'd be about 11,150 in the next week or two, and hold there and then go up one more time, which again, after this big a throw over rally, that's less likely to me, but hey, there's the market on crack, you can't count anything out. Or we break that in September, and then this was a top. So this is looking very, very toppy. Gold, which I'm gonna have an update for subscribers next week, because I've been waiting. Gold did break the new highs. It looked to me like it really needed a correction after that, and usually that does happen. You usually get a 5 to 7% correction after a market breaks the new highs. You go back to where you broke out, and that's what gold's trying to do here. It got near 1900 the other day. It bottomed, and I sense that it's probably got a little more downside to make a bottom. Gold does look to me like it's going to rally one more time, and it may take a while to do this, or it could happen quick. I tend to think it may take a couple months to do this, and it may go sideways for a while, but 2200 is very strong resistance on gold. So we got the bubbles that keep going. Gold is bubbling at the same time as stocks. Gold and stocks are bubbling together, which sometimes they do, sometimes they don't. But overall, since 2009, gold has bubbled up in the same realm as stocks and other risk assets. Stocks just are the biggest bubble. They get the biggest benefit from quantitative easing, more than bonds and real estate and gold. Gold, bonds, and real estate are kind of in the same realm, really bubbly, most in history, but stocks have taken the peak of this bubble. And again, we're just going to have to keep monitoring this and see what happens, because this bubble's out of control. And again, just as we saw this week, no matter what happens, the Fed and central banks will step in and say, well, we'll just do more. Well, more won't work at a point, and I think we're at that point. That's my professional opinion, knowing this bubble never ends, but knowing it has to end, and I'm 100% on that. This bubble will burst. If there was one bubble like this in stocks, real estate, or bonds, or anything that went up this extremely in a 5 or 7 or 8 or whatever period, in a time period like this, and just plateaued out and did not crash, if there was just one, I would say that's a possibility. So I get that argument all the time. Harry, what if they just keep printing, or what if we just kind of plateau out at some point and they don't let it go down? No, this thing will go down because of its own extremes. There is a price earnings level. There is a real estate level in prices where even billionaires can't afford a penthouse on Central Park anymore, you poor people. So there's a limit to every bubble. Bubbles defeat themselves. We are getting very, very close. We may be there right now on stocks, and gold may have one more run ahead. That's my best forecast. We're most likely at it at stocks, if not maybe a month or two after a correction in September in the election, and then we head down, and gold probably has one more rally. I think it's going to be very hard for gold to get over 2200. I agree with that guy, the article in Bloomberg. Gold is and I showed this the other day in Harry's take. 3 charts, gold versus every fundamental there, versus the CRB, the most fundamental, the most overvalued by far ever, versus silver, got up to 116 times when 60 is normal. That's almost as much as stocks, 100% overvalued almost. And versus inflation, only one time was gold slightly more overvalued, and that was 1980, when we had real inflation, 14, 16%. All we have now is imaginary inflation from massive money printing, which never incarnates, and it will not. Oh, maybe we get up to 3 or 4 in the late stage of this. We are not going to see 10 to 12% inflation, and we're not going to even remotely see hyperinflation. We're in the deepest deflationary environment since the 1930s. You cannot create inflation because banks and consumers are so in debt they can't borrow more money to create bank deposit type inflation, which creates consumer inflation. This is financial asset inflation, directly buying assets by central banks, pumping up all financial assets, stocks the most, but all of them, bonds, stocks, and yes, gold and silver. So that's what we're in. And it is going to crash. And this 90-year cycle is the last major cycle to hit. And only thing I tell people when they say, well, this could go up forever, I'm like, okay, I'll give it like 1 or more 2 years, because this 90-year cycle is the most powerful one. If this does not burst this cycle, and I think by the first or second quarter of next year, if this does not visibly burst by then, and we see a 40% or more crash, steeper than the ones we've seen. And note this, since the January 2018 top, every crash, 10% and then 20-some% and then 35%, every crash has gotten steeper. This is a classic megaphone pattern, and that's the key target to summarize here for the S&P. 2200, key resistance on gold here. If it can break strongly above that, okay, then maybe we get 3,000. I don't think that's going to happen. The resistance on the S&P is a little over 3,500, heading towards 3,600 if we last till the election in this rally. That's only a couple percent above here. That's very strong resistance on a very powerful megaphone pattern. And that projects a low of 2,100 if we hit those areas. And we don't even have to hit that. When you're making the final wave up in a major long-term pattern of a channel, or particularly a megaphone pattern, the last wave up will almost never just go right up to the top trend line and give you a layup. It will either not make it there and then turn around before you get short or get out, or it'll do a throw over rally that's convincing and convince you it's going higher. So we don't even have to get quite to that S&P target, as I said the other day. So again, all I can say, wild ride. Markets are getting really crazy here. I'm getting friends called me up, just feeling the same way I am. When is this damn bubble from hell gonna burst? And that's a good sign that we're probably very close. I'll keep you updated.